I mean, the answer basically is that we're heading for the most enormous crisis in the gold market. And the figures are very different for silver because being an industrial metal, et cetera, but the same principle applies. The liquidity is just simply not there, which is why it's sort of hurtling up $1 at a time at the moment. This is a squeeze on the system. And, this is very serious. And I think so, I can understand your punter selling off, $1,000 below the current level and maybe living to regret it. But, I can understand that. But the bit he's missing basically is he's going to be out of the market on the biggest, sharpest squeeze probably seen in history. I think that's where we're heading.
The dynamics of global gold markets are shifting dramatically, and Alasdair Macleod has been sounding the alarm for years. According to Macleod, the traditional dominance of Western powers in controlling gold reserves and market movements is increasingly being challenged. For decades, the West, led by the US and Europe, dictated gold pricing, trading, and policy. But recent trends show that Asia, particularly China and India, is quietly taking control, setting new rules that could redefine the global financial landscape. This isn't just a minor shift, it's a structural transformation that could have long-lasting consequences for investors worldwide. Macleod emphasizes that central banks in Asia are not just accumulating gold for the sake of reserves, they are strategically repositioning themselves to reduce dependence on Western financial influence. With the US dollar no longer unassailable as the global reserve currency, these nations see an opportunity to protect their economic sovereignty. Macleod points out that China, for instance, has been steadily buying gold while simultaneously promoting the yuan as a serious alternative in international trade. India, on the other hand, has been leveraging gold both culturally and economically, ensuring it remains central to national wealth and personal savings. The shift is also visible in trading patterns. According to Macleod, Western gold exchanges are no longer the sole centers of price discovery. Asian exchanges are gaining prominence, with trading volumes and influence steadily growing. Investors who fail to recognize this trend risk being caught off guard as gold pricing and availability increasingly reflect Asian priorities rather than Western market mechanisms. Macleod further highlights the implications for global geopolitics. As Asia accumulates gold and builds alternative financial frameworks, the West's leverage over global markets diminishes. Gold, historically a cornerstone of Western monetary power, is gradually becoming a tool of empowerment for Eastern economies. Macleod argues that this isn't just about wealth preservation, it's about influence and strategic positioning in a rapidly evolving world order. Countries with strong gold reserves can shield themselves from sanctions, currency volatility, and global financial shocks more effectively than those relying solely on fiat systems. Now, we present the clips from interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Yeah, well, I think your friend who took his profits $1,000 below this, you'll probably power back in over 20,000 sometime. I don't know. That's what tends to happen. I mean, I speak as as a stockbroker of some decades, knowing the human behavior, if you like, of investors and speculators and so on and so forth. And there is absolutely no doubt. I mean, the sensible advice to an investor is when you've got a nice profit like that, book some of it and just run the rest for free. As for overbought, no, it's not. If you just look at the open interest on COMEX, there's no way it's overbought. I mean, the amazing thing is that most of this rise, both in gold and silver, has been on the back of a bear squeeze, not, enthusiastic buyers rushing in and buying it. And there's a complete misunderstanding, actually, about what gold is about. I mean, there are enough gold bugs running around saying, oh, it's going to the moon, or it's going to do this, going to do that. But actually, do they really know what they're talking about? I mean, they tend to look at charts, let's face it. And they've also got this thing in their brains about, government is wicked and therefore gold is good. It's not good enough, actually. You've got to really understand what the game is about. The point is that, it goes back all the way to Roman times. They decided the difference between final settlement and deferred settlement was settlement in something without counterparty risk. And that was metallic. And, when they produced the first Roman laws were dated in 448 BC. They said, settlement is metallic. In those days, it was a pound of bronze, basically. That was the unit called the ice. And gold came later, of course, because it's a lot more convenient and so on. And it was also being discovered a bit more. So, there was a little bit of quantity there. So it could be used for the temporary storage of one's labor, if you want to really sort of go back to classical economics. But otherwise, everything else is deferred settlement. It's a promise. It's a promise to pay. You might think that you're paying a workman for painting the outside of your house. And, okay, fine, you paid him. But there's not final settlement, because what you've done is you've done a probably cash, in which case it's the counterparty risk is actually with the central bank, or alternatively, by bank transfer. In other words, you've just transferred one form of deferred settlement for another. Nobody does final settlement nowadays. But when you get a loss of confidence in the value of the currency, which is the top level of credit, if you like, in any economy, then that loss of confidence is reflected in a falling value for the currency. And that is exactly what's going on. So the idea that gold is overbought, oversold is rubbish. It's got nothing to do with it. Really, what we're looking at is the relationship between gold and fiat currencies, which depend entirely on faith. And it's as simple as that. So, where are we? I mean, I think we can really say that gold over millennia basically its purchasing power varies very, very little, and there's ample evidence of that. But when it comes to fiat currencies, they come and go. They don't last terribly long, is a short answer. I mean, the dollar has really been a fiat currency for some considerable time. I would say since 1933, if you like, just before they devalued it from 20.67 to $35 an ounce. But more specifically and more obviously, since the Bretton Woods Agreement was suspended actually in 1971. So we've had 54 years of pure fiat currency. But the destruction process actually started earlier than that. So we just bear that in mind. I think really what gold is telling us is that we're coming to the end of that era. And, anyone who's left holding the fiat baby is, basically has had it. That's what's going to happen. So that, I think, is the background. But the interesting thing is that the Chinese, who are a bit old-fashioned over these things, they didn't have the benefit of John Maynard Keynes teaching them economics, etc. They came out of communism, if you like, with the belief that the capitalist system would fail. And of course, the failure of the capitalist system, would be through its currency. And so they started accumulating gold, really, shortly after Mao Zedong passed away. And I've got an English copy of the regulations dated 1983, appointing the People's Bank of China with the sole responsibility for managing and acquiring the nation's gold and silver reserves. And this is terribly important. It's important to know this. The second thing to know is that no one in China was allowed to own gold until it was legalized in 2002. And that was the point where the Shanghai Gold Exchange opened, which facilitated the delivery of gold to the public. So we had this period between 1983 and 2000 when the China state acquired gold. And so where did it come from? Well, we had a massive bear market between those dates. And not only that, but, it was quite clear that quite a lot of central bank gold held in the West had actually gone out on lease, never to be returned. This was estimated by Frank Venerosa to be somewhere between 10 and 14,000 tons. In other words, between a third and a half of all central bank gold was out on lease, sold into the market, and not coming back.
For individual investors, MacLeod's analysis underscores a critical point. Understanding the flow of gold isn't just about numbers on a screen. It's about recognizing the broader currents of power, influence, and economic foresight. Those in the West who continue to treat gold as a niche investment may find themselves increasingly marginalized. In contrast, those who monitor Asian policies and gold accumulation trends will have a clearer picture of where markets are headed. MacLeod stresses that ignoring these shifts could result in missed opportunities or worse, exposure to unexpected market turbulence.
State-owned refiners were bringing in doré from abroad. I mean, particularly, obviously, Mongolia, and paying them for the doré. And where did the gold go? Didn't leave China. I mean, as far as the relationship between gold and China is that China is Hotel California. It comes in, that's no problem at all, but it can't get out. So that has been the policy. Why is it this policy? It's this policy because the Chinese understand the importance of gold. Now, since the SGE Open, over 27,000 tons of gold has been delivered into private hands. Now, some of that would have returned into the Baltic system as scrap. But I don't care because that just gets redistributed elsewhere. It's not going out of China. Never has done. And on top of that, of course, you've got the banks. The banks run gold accumulation plans for their depositors. And this gold is not delivered out of the Shanghai Gold Exchange. It is stored within the Shanghai Gold Exchange. So we don't know how much gold there is there, but I should think it's quite a lot. I pencil in a figure about 10,000 tons. Now, I think that might underestimate the situation for the very simple reason that household savings rate is in the order of, it's over 30%. And that's the equivalent of $5 trillion a year. Now, it used to go into off-plan apartment buildings and stuff. That's gone. Let's forget that. Stock market, maybe a little bit, but I think that's got very, very limited appeal. I mean, really. And then the other thing you've seen, I mean, mostly it's been accumulating as deposits on the bank's bank accounts, deposit accounts. But for the last year or two, the People's Bank has been reducing its sort of main interest rates, and the bank's with it. And so what does the housewife do? Well, the answer is that she opens a gold accumulation plan, which she can do for as little as 500 yuan. So that's, which is less than $100. So, this is actually very important. If you take this all together, we are, in my estimation, looking at a figure like 75,000 tons out of a total of a bit less than 200,000 tons of above ground gold stocks. China has cornered the gold market. That's what it boils down to. Because it's not just China. You've got India, which has got massive amounts of bullion held in the form of jewelry. I mean, most of the Chinese public gold is actually jewelry as well. And you've also got Russia. Now, I understand on pretty good authority that Russia's got two sovereign wealth funds, which have a total of about 10,000 tons of gold between them. And then you've got the Russian Central Bank, which has got a further, 2.3 thousand tons, whatever. You've also got the whole of the Shanghai Cooperation Organization and BRICS, all their central banks. Presumably they've got sovereign wealth funds as well. Now, all this is meaning that the liquidity we have here is minimal. Now, let's look at the demand side. So far, this hasn't mattered because nobody wants to buy gold. I mean, any investment manager isn't going to earn fees by putting his punters into gold. He would rather put them into something which is going to pay him a bit more. And not only that, but the regulators are on his side. The regulators turn around and say that, physical metals are not regulated investments. But of course, this is why they set up ETFs, to get around this regulatory hurdle. But the ETFs are beginning to grow. People are beginning to buy into them slowly. But the other thing, which I think is very important on the demand side, is that we now see analysts at the major US banks turning around and saying, we believe gold's going at 4,000, whatever their reasons. I don't care. I mean, they don't know what they're talking about. I reckon that's my default assumption anyway. But, the fact that they are saying it, and the fact that the investment managers within those banks, who are typically managing or responsible for over $1 trillion. We're looking at banks like Goldman Sachs, Bank of America, Citibank, Citicorp, whatever they call themselves now, etc. We're talking about huge numbers. They haven't got any. I don't think they necessarily know how to get it, actually. I mean, so that, this is interesting. When you look at the complete investment management universe around the world, it is estimated that portfolios are worth some $300 trillion. $300 trillion. Now, gold ownership of that, you just look at ETFs and maybe sort of make a few assumptions about, bullion being stored and so on. But basically, it's ETFs and nothing else. It's less than 0.5% of that. I mean, it really is. Less than 0.5% is in gold. And yet you've got these behemoths in America now thinking, we better buy some of this. Now, to put it into context, my China story suggests that the amount of liquidity, which is unspoken for, including jewelry in the West, is probably in the region of about 40 to 45,000 tons. That's all. That's it. We can see what's in the vaults. We can't see what's in the Swiss vaults. That's something I don't know. I would, someone gives me a number, it'd be super. But I think quite sensibly, the Swiss don't produce these numbers. That's what I would assume anyway. But it does mean that if a 1% increase in allocation, portfolio allocation of that 300 trillion was to take place at current prices, you're looking at 25,000 tons. Where's it going to come from? I mean, the answer basically is that we're heading for the most enormous crisis in the gold market. And the figures are very different for silver because being an industrial metal, et cetera, but the same principle applies. The liquidity is just simply not there, which is why it's sort of hurdling up $1 at a time at the moment. This is a squeeze on the system. And, this is very serious. And I think so, I can understand your punter selling off $1,000 below the current level and maybe living to regret it. But, I can understand that. But the bit he's missing basically is he's going to be out of the market on the biggest, sharpest squeeze probably seen in history. I think that's where we're heading.
Looking ahead, the global gold market appears poised for a profound transformation. As Asian nations continue to amass reserves and assert greater influence over pricing and trading mechanisms, traditional Western dominance in the gold market is likely to diminish further. This shift signals that gold may increasingly reflect the priorities and strategies of Eastern economies rather than Western financial institutions. Investors can expect a landscape where gold pricing, accessibility, and demand are driven more by geopolitical strategy than conventional market speculation, creating both risks and opportunities for those who pay attention to these changing dynamics. In this emerging paradigm, gold is set to become not just a store of value, but a central pillar of financial sovereignty for nations. Countries that hold significant reserves will gain leverage in global trade, reduce reliance on volatile fiat currencies, and protect themselves from systemic shocks or sanctions. For individual and institutional investors, the lesson is clear. The rules of the game are changing. Those who align their strategies with the shifting flows of global gold accumulation stand to benefit, while those who ignore the structural transformation risk being left behind in a market increasingly shaped by long-term strategic positioning rather than short-term trends. If you found this breakdown useful, make sure to hit like, share it with others who follow the metals market, and drop a comment below with your thoughts. Don't forget to subscribe so you never miss the latest updates. Thanks for watching.